Hello everyone and welcome to the channel. This channel is dedicated to issues related to the NRIs. Now the examples that I take in the slide or the channel may be focused on the North American NRIs, but they are equally pertinent or equally applicable to NRIs across the globe. There may be certain nuances in terms of the tax treatment or the way situations might change, but on the whole, I would say things are pretty much the same that relate to NRI population. So I'll be open to reading the comments or suggestions or feedback regarding the channel and its content, and I hope that you like to subscribe to the channel and listen to the content, and also provide your constructive feedback so I can improve the content and the topics that I cover. Now, at the onset, I do want to make sure that this is for educational purposes only and it's not an investment, tax, or legal advice. For that, please consult your own legal advisor or investment advisor. So today's uh, topic is especially on the FCNR deposit scheme, which has been introduced by the Reserve Bank of India, that recently introduced a special FCNR deposit window that will remain available until the September 30th, 2026. Now, the banks across India are promoting these deposits as an attractive opportunity for the non-resident Indians to earn higher returns while keeping their money in the foreign currency. As you know that one of the biggest drawback for deposits was the money that NRIs were sending to India for deposits were in Indian rupee, and over the years the rupee has been devaluing a lot. If you compare in the last 10 years, you've seen the devaluation of the rupee, and any net gains that one gets out of the returns or investment gets nullified if you're drawing that money back or equating that money back into the foreign currency. So in this video, we will examine what FCNR deposits are, why the RBI introduced this special window, the benefits they offer, and 5 important reasons why many NRIs should carefully evaluate them before investing. So in today's agenda, we'll cover these 5 areas. First, we'll explain what FCNR is. Maybe most of you do know, but however, for the viewers who are here and are not aware of what FCNR is, we'll quickly cover what that is. Secondly, we'll look at why the RBI introduced this special window. Third, we will discuss the potential benefits. And fourth, we will examine 5 important concerns that investors should consider. Finally, we'll discuss who may benefit from these deposits and conclude with the key takeaways. Now, before evaluating whether this investment makes sense, let's first understand exactly what the FCNR deposit is and how it differs from the other NRI banking products that are in existence in the market. Now, the FCNR deposit stands for Foreign Currency Non-Resident Bank Deposit. As I explained, unlike the traditional NRE deposits where foreign currency is converted into Indian rupee, FCNR deposits allow the NRI investors to maintain deposits in designated foreign currencies such as the US dollar, the British pounds, euros, Canadian dollars, Australian dollars, and Japanese yen. And based on one's requirement and preference, NRI is eligible to keep deposits in any of these or currencies that are being offered. So this means your principal and interest remains denominated in foreign currency. For example, if you deposit 100,000 US dollars, your funds remain in dollars throughout the investment period. Now, this structure eliminates direct rupee depreciation risk and is one of the major attractions of the so-called FCNR deposit promotion that we've been receiving from various sources. So let's quickly go over why the need, why it has been introduced by RBI, and it's no rocket science. I mean, we've been seeing the situation of rupee sliding uh, heavily in the last couple of months, and that is now one of the steps why the banks are aggressively marketing these deposits. We need to understand broader economic objectives behind the RBI's decision. So we all know that India relies on foreign currency reserves to finance imports, manage exchange rate stability, and support economic growth. During the periods of global uncertainty, central banks often seek ways to attract additional foreign currency inflows. Now, in the past, whenever there was the risk of rupee sliding, the RBI would intervene, um, stabilize the rupee by selling dollars, buying rupee, and thereby interjecting and providing a floor for the slide of the rupee, and that would take care of it. Now, rupee would depreciate, but not to the extent that we've seen in the last couple of months. So the RBI special FCNR swap window enables banks to mobilize foreign currency deposits from NRIs while reducing certain currency management costs. So this results in greater inflows of dollars, euros, and other foreign currencies into the Indian banking system, given that now we'll have an opportunity for foreign currency to be brought in the country's economic system and locked in for a period of 3 to 5 years. So there is some stability of the outflow, not inflow but outflow. So while the program benefits the depositors, it is also an important monetary policy tool designed to strengthen India's foreign exchange reserves. So for in simple layman term, the money uh, in terms of the foreign exchange is being attracted into the country to stabilize, the outflow that we've witnessed, and thereby providing certain breaks on the rupee slide. So, what's a positive side? Now, before discussing the drawbacks, it's important to acknowledge that FCNR deposits do offer several legitimate advantage for certain investors. Now, the reason I call it certain is because it is applicable to individual needs. So it's not a um, you cannot say that this basically applies to the entire population of NRIs. Now, majority of NRIs, yes, but there are certain specific areas where it it may benefit NRIs to a greater extent than the others. So first is the currency stability. Since deposits remain in foreign currency, investors avoid direct exposure to the rupee depreciation, though, so they are not really, like in a panic mode where we hear the foreign investors, they come in, invest in the Indian capital markets, and when the situation suddenly turns, a huge outflow is then witnessed that sort of creates a momentum that leads to a faster rupee depreciation than what it normally should. Now, it's a different story why we've been regularly witnessing a rupee depreciation, since the last several decades. We can go into that in a different, you know, um, slides or different presentation. That's a entire different argument. But today we'll focus just on the current situation of the FCNR deposit. So second is that the deposits are being held within the regulated Indian bank operating under the RBI oversight. So you do have certain sense of safety. Now, RBI has a stellar record of oversight, and by no means uh, you can say that any money deposited in the Indian banking system is at risk of default. So that's a huge advantage. Third is predictable returns. Unlike stock markets, these returns are generally known in advance because they are contractual. They are already been specified. So it's like a FD deposit where you know exactly what returns you'll be getting and at what point of time. So it creates that stability and certainty in terms of the returns. Now, fourth is the planned benefits. Investors with known future expenses, such as maybe you need funds in 4 years, maybe you need funds in certain number of years ahead. So you are assured of this return and the principal that could be used for educational costs or property purchase or family obligations, and may find the predictability particularly valuable. So it's not the timing of the stock market. For example, my stock portfolio may be doing really well, but then suddenly hits a certain volatility period, and then you have at the time of withdrawal when you need the funds, you are maybe making a compromise, which may not be the best of time to withdraw your funds. So these are, some of the core areas that one should really consider. So these are meaningful advantages, but they must be weighed against several important considerations in terms of making the deposits. Now, 5 reasons that I've identified that NRIs need to think twice. Now, could be more, could be, some other areas I missed, and I'd love to hear from you in your comment section. So now let's discuss the 5 major reasons why FCNR deposits may not be the optimal choice for many NRIs. Again, I'm saying many, I'm not saying all, but many seeking long-term wealth creation. Now, what are those reasons? Now, the real return may be lower than inflation. So on paper, yes, it says you get about 6.5% return. But my first concern is inflation. Many investors focus on stated interest rate, but what really matters is return after inflation or the effect of inflation. So if inflation in countries like the US averages between 2 and 3% annually, and your deposit return is only modestly above the level, your purchasing power may barely increase over time. So uh, you have to look at the opportunity cost. You are foregoing your current consumption for a future date, but you have to realize what the net purchasing power uh, of these dollar would be in next, 3, 4, or whatever time that you are locking in for. Now, for some, again, it may be okay, but for majority, that may be a different scenario. So in other words, while your account balance grows, your real wealth may not grow significantly long term. And investors should always evaluate investments based on real returns rather than nominal returns. So simply to say, what's on paper may not be in effect what is the reality. So make sure you've weighed that and you've discussed that with your uh, banking representative about this aspect. So the other thing is, and it's from personal experiences, the banking bureaucracy can be frustrating. I'm talking about public sector banks. I'm talking about the private banks. They're equally the same. No disrespect to any bank in particular. I mean, I dearly respect the hard work that these reps undertake, but is the bureaucracy that really, uh, is a hassle. So this issue is administrative complexity. Opening and maintaining NRI banking relationships often involve extensive documentation, including the KYC verification, the FATCA declarations, address verifications, tax forms, and repeated requests for supporting documents. So while relationship managers may suggest that the process will be completed quickly, many NRIs report timelines of 3 weeks to 1 month or longer. And it's not until you have completed all the documents, you have signed from both sides and you got verification, your document is your deposits are in effect, that's when the clock starts. So the time, effort, and frustration involved should be considered part of the true cost of investment. So third is the funds are being locked for years, so I think investors should be careful about this. So the liquidity. The deposits generally require investors to commit funds for approximately 3 years. During this period, you may have limited flexibility to redeploy capital into other opportunities. Now, market conditions can change dramatically over 3 years. Investors may encounter more attractive opportunities elsewhere. So, for investors with surplus funds that they know they will not need, this may not be a problem. However, for those who value flexibility, liquidity has real value. So, for example, if there's suddenly another opportunity that came your way in terms of a property for which you need a down payment in your foreign country location, and this money is locked into the deposit in India, then having those funds coming back to you and then using that for your opportunity overseas may be a bit challenging. So make sure you weigh that before you take the step for having this deposit going. Now the biggest issue is the tax and reporting complexity. Now the fourth concern is tax compliance. Now, NRIs residing in countries such as the United States, Canada, and the United Kingdom and Australia are required to report, taxes. When you're reporting, obviously in India, you have to file taxes and report. However, importantly, when you are filing taxes in your residence country, you do need to provide your total investment scenario, and it can be a little challenging when you have uh, documentation coming from different sources from different countries. So for US based investors, this could include the FBAR reporting, FBAR reporting, the FACTA disclosure, and other foreign account reporting obligations. Now, many investors ultimately require assistance from international tax professionals. These additional costs can reduce the net attractiveness of investment and should be factored into overall decision. So, in certain situations when one is not a big investor, for say, then it's could be a better to just invest in the local capital market in the home country where you are residing and generally report your taxes as needed for capital gains. That's a much easier and flexible path. So the fifth and the most important consideration is the opportunity cost. Now, historically, broad equity index funds tracking, for example, S&P 500 in the US, have delivered average annual returns in the range of approximately 10 to 12% over long periods. So while future returns are never guaranteed, these investments offer liquidity, growth potential, and relatively straightforward administration. So compare the deposit in this scheme where your funds are locked for 3 years versus, let's say, you took the funds and invested in an index fund such as the Vanguard VOO, which is linked to the S&P 500. There, the entry and exit are pretty straightforward. You can access and get your funds back just in maybe a max of 2 or 3 days. The obligations are simple. You get your capital gains, worksheet that you report in taxes. So it's not a big, comparison or comparable issue compared to uh, than investing in simply an index fund. So by locking funds into a fixed deposit, investors may forego opportunity to participate in long-term wealth creation through diversified equity markets. Now, this does not make FCNR deposits bad investment, I want to emphasize, but it highlights the importance of comparing alternatives. Now, my view in this is that you're comparing an optimal return of your wealth, and whereas you obviously have to take into the risk sort of profile and your own risk appetite. The main issue here is the comparability of returns. Now, if you, for example, want to draw out a portfolio where your risk appetite is minimal and you do not want to take any risk at all, that is, for example, you're coming very close to your retirement period, then yes, by all means, you should consider the FCNR deposit opportunity. However, if you have just started out on your investment journey and have maybe 10, 15, 20 years for your retirement, or when you need the funds, then it it really makes a better sense to invest in the capital markets to generate as much of returns as possible, and then slowly convert that into a safety net. Or maybe you want to just look at a traditional 60-40 approach where you say, okay, 60% of my assets are going to be in equity markets and 40 in bonds or debt instruments. Then yes, by all means, this should be a consideration, because you are definitely getting a 6% or 6.5% return compared to a 3 to 5% or 3.5% or 4% average in a debt instrument. So it is a consideration. It is a issue to consider. It's not a yes or no. So this is what I mean. But definitely these are the things that you need to consider and discuss. So who should consider FCNR? These deposits. So we're looking at certain investor profiles, which could be conservative investors who prioritize capital preservation over growth. Uh, they may also appeal to individuals seeking predictable returns, investors with future foreign currency obligations, and those holding surplus funds that they do not expect to use for several years, instead of having them left in a bank account that earns little or no interest. Then yes, it does make sense, a lot of sense actually. Now for or foreign or foreign investors, particularly, I mean, in this case the NRIs, instead of remitting funds and converting them into rupee and then locking into the traditional CD account or FD account as known in India, don't convert that into rupee. Just send the funds in the FCNR and have it invested in the FCNR deposit. And that would be a much better alternative. Ultimately, your goal should be to maximize your overall return of the wealth. That should be your maximum goal. Now, obviously, there is also the emotional content that I probably did not highlight, but investment does not work on emotions. It barely has a mention when you pick up any investment textbook. There's barely an mention of emotional content. Yes, for investor, it basically drives the investment decision, but the con- the consideration for investment is always wealth maximization and no emotion. So, but then yes, emotional connect to the motherland, the emotional connect to the country, and helping the country in its need. But then remember, NRIs are already contributing a lot by remitting huge amounts of funds to the Indian banking and economic system by ways of remitting funds, by way of purchasing properties, by way of investing in the capital markets. So that is already happening to a large extent. So So finally, what are the key takeaways? So let me summarize key points. Now, the RBI's special FCNR deposit window is designed to attract foreign currency into India's banking system and strengthen foreign exchange reserves. Now, for investors, it offers currency stability, predictable returns, and comfort of regulated banking institutions, and that's a huge advantage in terms of the Indian banking system, which is very rightly so tightly controlled and regulated by RBI, so the safety net is pretty strong. However, investors should carefully evaluate inflation adjusted returns, administrative complexities, the liquidity constraints, tax reporting obligations, and the opportunity cost of alternate investments. Now, if I recall, back in late 1990s, there was a similar scheme that was launched to attract foreign currency by way of these foreign currency bonds, which was very popular. It kind of helped the country a lot, and this is kind of a follow-up, but it'd be interesting to see how the investors really react to this scheme, because back then the information accessibility was a little difficult. That was the beginning of the internet age. So investors did not really know about alternatives, but now they are very sophisticated. I mean, the young professionals who are traveling and living abroad, who are or who became NRIs in the last, 10 years, they're very aware of what all these investment alternatives are. And it'll be interesting to see how they react to this call for investment. So we'll get to know, after September, when this FCNR deposit scheme, deadline passes, as to what the overall reaction has been. So the right decision ultimately depends on your goal, risk tolerance, liquidity needs, and tax situation. So we'll see how that goes.